Hi everyone, I'm here to do a discounted cash flow analysis of Apple. First thing we're going to need to do this calculation is earnings per share over time. A great resource I found is Macro Trends. They have it in a copy and paste format that's really similar to what I'm using now. I recommend going there and pulling as much vintage data as you need. Second step is we're going to take earnings per share and annualize it. I also like to look at earnings per share trailing 12 months. This gives us the earnings per share trailing 12 months figure we're going to need and extrapolate down the road. I also like to look at average share price over time. That way we can compare average share price and earnings per share annualized. Notice here in gray is the average share price. In blue here is earnings per share trailing 12 months. Notice how close these lines look together. This makes sense. As new earnings are released, the market adjusts for future value of the company. So the next question is, what information do we need to do the actual discounted cash flow? First thing I like to look at is the long trend averages for earnings per share growth over a long trend, which is greater than 5 years, 5 years, which I tend to rely on the most heavy, and analyst estimates. Notice for Apple that all the estimates are fairly close together, 8 to 11%. We'll walk through all of these. In this particular example, we have the low-end long-term trend. The earnings per share, 12.79 that we have from this calculation over here. The discount rate, or minimum rate of return, is what the investor anticipates the returns over time going to be on a compounded basis. We have a PE ratio, which is the multiple of what the market values earnings per share, and a 10-year share fair value, and a fair value net present value, which is a fancy way of saying what is the stock going to be worth in 10 years, and what would be, based on the other assumptions, a fair market value to pay today. One tool I like to use in financial analysis is the solver tool. What it allows you to do is calculate, given on certain constraints, an input or an output. So let's walk through this. If you open the solver model, you'll set the objective, G14, the premium discount to market, to a value of 0. What this means is whatever the stock price is right now, I want it to be the net present value of the future cash flows, i.e. the difference would be 0. By changing variables in G8, which in this case is the discounted rate, my minimum rate of return. So if we click solve, we can see that I can actually afford to pay a little bit more than what the stock net present value was, i.e. the price of it is today, and it will clear my hurdle rate of 7.25. This is because the PE, or the multiple, is so large and highly unlikely to continue into the future. Conversely, we can say, what if the PE ratio returned back to the mean or average that it has over the last, say, 5 years for Apple? In this case, let's put in 17. That's close enough. We can go back to our solver model and run the same formula. Now we notice that since we've overpaid, quote unquote, for this stock, that our objective of 7.25 is not going to be met. This is why we have to be really mindful of what normal PE ratios are. To illustrate this example more, I've built out some tables. Notice that we have the long-term trends of EPS ranging from 8 to 11%. Those were the long-term trends, 5-year trends, and analyst estimates, along with a PE scalar, all the way from the historic median all the way up to what it's trading at currently. These are the present values of the stock based on what those EPS and PE multiples would be. This is the future value grown at EPS over time at the low, average, and high rates. So in the middle here, you'll notice that I have a little function to where if I put in what the price is, or the buy at, what would my future returns be for any given interval? Notice that on the low end it would probably be around 3%, and the high end would be 10.6%, and that the vast majority in the middle here would be around 5, 6, 7%, or what a normal valuation would be if EPS estimates are correct. This is also helpful because what if the market had a dramatic pullback? In March, there's about 2 weeks that you could have bought Apple for under $250 a share. Notice that all those nearly doubled in the low range and went up by a few percent in the high range, and that your average return was looking more like 8 or 9%. Based on the EPS, as long as the trends didn't change too much or there wasn't any material changes in how the business operates, I think it would have been a great time to buy to increase the yield from that static pool purchase. Let's take another look at these valuations from another perspective. What I've done here is retain the same 7.25% discount rate, or minimum rate of return that I require, and forecasted it based on different PE multiples. PE multiples change over time. FANG stocks are very hard because the multiples are typically much higher than the historic mean of an index, say the S&P, which is around 16 or 17. So I've put benchmarks of 14, 16, 22, and 27. Here are the trends for the last 5 years of the stock, and each one of these could make sense. But what I want to look at is in the relationship of how much does it cost now, as indicated by the blue star, based on the probability of what the PE multiples might be, where would be a reasonable range to buy that stock. We could use this tool over time as long as EPS trends don't change, or we could revise the model 1 to where when over time, let's say in 2025, if Apple is valued at around $400 a share, it's probably an average buy. Now, if it were averaged around $300 a share, that would be an indicator that the PE multiple is extremely low in relationship to the historic mean, and we'd probably need to make a purchase. Hopefully, looking through the discount cash flow model, you'll learn that earnings per share growth, a required rate of return, and understanding PE multiples will give you a solid valuation, in this case over 10 years. I hope you enjoy the content. Please like and subscribe. Thank you.